what I'd like to talk about is the Credit Crunch paper you wrote recently, the Credit Crunch Revisited, which is, it's on your blog, I think.
Absolutely.
And I think it's also available on the website.
Yes, it is.
Right. I mean, what really compelled you to write a follow-up article on this?
I think what intrigued me, first of all, Chris, was the fact that we've had continuing website hits to a Credit Crunch article that I wrote, I would say, about 3 years ago. So clearly there is an awful lot of interest in the subject. The second point that I would make is that I believe I'm very much scarred by being associated with the banking industry. The number of times that I've had to justify my role as a banker at dinner parties with a sense of shame and a sense of guilt really causes me to reflect on the causes of the credit crunch and wants me to do everything that I can to try and make sure that what happened never happens again. So I'm quite keen that the lessons that led to the credit crunch really are learned and action really is taken.
I think that's an interesting point. I think one of there are two things that you get to in that paper. I mean, on the first hand, there's this realization that some things are getting better, and then on the other hand, there are certain things which I think you're saying are not being addressed. What do you think's getting better?
Well, I'd really like to focus on the positives. First of all, there is more capital. Banks are far more capitalised than they ever were. They're in a far better cash position to sustain the unexpected. Secondly, there is a lot more liquidity in the system. The other thing I would say is senior management are much more competent. They understand the technicalities of the business to a far greater degree. The final point I would make is one of the key causes of the credit crunch was human greed, money. The new remuneration codes, the principles on remuneration, I believe have put the industry on a much surer footing when it comes to the management of human greed.
Okay, I think that's talking about what's getting better, and I know you like to focus on the positives, but what hasn't improved? What are the implications of that? Because, you know, some of those things have been fixed quite quickly, but maybe there's a longer term view.
Chris, we're on a journey. So for example, if we look at capital, I think some regulators have overdone it. Certain businesses that in my opinion are in the public interest, for example, securitisation, these businesses are being killed by excessive capital in certain jurisdictions. Secondly, in terms of liquidity, the article talks about the balkanisation of liquidity. That is to say, national regulators doing their own thing to make sure that their own banking system is looked after. To me, liquidity needs to be managed from a global perspective. Thirdly, is it really only about money? Will a remuneration code solve all of our problems? I think we still need to think about what motivates bankers to do things that perhaps they shouldn't be doing. And finally, Chris, this focus on expertise, well, it's a focus in the large institutions, but what we're seeing here in the City of London is not enough regulatory resource to actually focus on the expertise of the middle tier.
Just one last question before we wrap up. I mean, what do you hope to achieve by writing this article?
I want to promote interest in this subject. Some of it is therapy for me. I'm scarred by the credit crunch, so writing the article makes me feel better. But the important thing is I hope to keep the spotlight on the lessons and do my small bit in keeping the momentum on dealing with the root causes of the crunch.
Excellent. Well, I think that's given some of our viewers something to think about. And clearly, you know, on the website, they can actually read your full article, or even if they go to your blog, right?
Absolutely.
Good. Well, let's hope they do that.